If you work at a university, research institute, national laboratory, or other academic institution, there is a good chance that you have heard terms like 401k, 403b, 401a, pension plan, Roth account. For many researchers, these terms appear on employment paperwork and then disappear into the background. Yet retirement accounts are among the most important financial tools available to many employees. In this video, we'll discuss what retirement accounts are, how they work, why they receive special tax treatment, and why every researcher should understand the options available through their institution. Before discussing retirement accounts specifically, let's revisit a framework that we'll use throughout this investing series. Most long-term financial planning can be thought of as three buckets. Bucket 1 is your emergency fund. This is money intended for unexpected expenses and short-term financial stability. Bucket 2 is retirement accounts. These are long-term investment accounts that often receive special tax treatment. Bucket 3 is brokerage accounts. These are flexible investment accounts that can be used for goals outside of retirement. Today, we're focusing on Bucket 2, retirement accounts. One of the most common misconceptions is that a retirement account is an investment. It is not. A retirement account is better thought of as a container. Inside that container, you can hold investments. For example, index funds, mutual funds, bond funds, and other investment options. The account itself is simply the structure that holds those investments. This distinction is important because many people hear the phrase retirement account and assume the account itself is generating returns. In reality, the investments inside the account are what grow or decline in value over time. Understanding this concept makes it much easier to understand investing in general. Depending on the institution, researchers may encounter several different types of retirement plans. Some common examples include 401k plans, 403b plans, 401a plans, pension systems, individual retirement accounts, often called IR, as. The details vary considerably between institutions. Some plans are available only to certain employee categories. Others may include employer contributions or matching programs. The important point is not to memorize every account type. The important point is to understand which plans are available to you. This is one reason speaking with human resources, payroll, or a benefits office can be extremely valuable. One reason retirement accounts are so important is that many offer tax advantages designed to encourage long-term saving and investing. Broadly speaking, there are two common approaches. In some accounts, contributions are made with pre-tax money. This means the contribution may reduce taxable income today, but taxes are generally paid later when money is withdrawn during retirement. In other accounts, contributions are made with money that has already been taxed. In exchange, qualified withdrawals during retirement may be tax-free. This second approach is commonly known as a Roth account. The exact rules depend on the account type and local regulations, but understanding this distinction helps explain why retirement accounts are often prioritized before ordinary investment accounts. It's also important to remember that retirement accounts and investing are not separate topics. In practice, retirement accounts are often one of the primary ways people invest for the long term. Some employers offer matching contributions. This means that when an employee contributes money to a retirement account, the employer may contribute additional money on their own according to rules defined by the retirement plan. This is basically free money. Not all institutions offer matching. The amount varies significantly, but if matching is available, it is worth understanding how it works. This is one of the first questions I would recommend asking human resources or your benefits office. You might ask, is matching available? What percentage is matched? Are there vesting requirements? What do I need to do to receive the full benefit? Many employees are unaware of these details. Taking the time to learn them can be extremely worthwhile. One concern frequently raised by international researchers is whether retirement accounts still matter if they do not plan to remain in the same institution or even the same country permanently. Academic careers are highly mobile. Researchers often move between institutions, sectors, and countries throughout their careers. A common misconception is that retirement assets somehow belong to the employer or remain tied to a particular institution. In general, retirement accounts belong to the account holder. If you change jobs, move to a different institution, transition to industry, or relocate internationally, the assets do not simply disappear. The specific rules governing withdrawals, taxation, and transfers can vary, and professional advice may be appropriate in some situations. However, the key point is that retirement accounts are personal financial assets, not institutional property. Understanding this distinction helps many researchers feel more comfortable participating in retirement plans early in their careers. Let's end with 3 practical actions. First, contact your human resources, payroll, or benefits office. Ask, what retirement plans are available? Am I eligible? Is employer matching available? Second, if you already have a retirement account, find out what it is invested in. Many people contribute for years without knowing what investments they actually hold. Third, spend some time reading the information provided by your institution. You do not need to become an expert overnight. The goal is simply to become familiar with the system. Financial decisions become much easier once you understand the tools available to you. In the next video, we'll discuss a question that many researchers eventually face. What should you do if you want to invest beyond your retirement account? We'll discuss brokerage accounts, how they work, and how they fit into a long-term investment strategy. Thanks for watching, and I'll see you in the next video.